Hi, everyone. Welcome to the 116th episode of the Timing Research Show for December 12th, 2016. My name is David Kosmeter. I'm the creator of Timing Research, and today we will be discussing the 168th weekly report. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download this or any past report there. I have Dean Jenkins back to host today, so I'm going to go ahead and turn it over to him.
All right, David. Well, thanks for having me back. I always look forward to this. I enjoy it. Get to come spend about an hour talking about the market, talking to traders, and hearing ideas from some really smart, successful people. So this is good stuff, and I'm glad to be here. So we'll just go ahead and jump right in to the big question of the day, and that is, what direction do you think the S&P 500 index?
Yeah. Do a quick introductory round for each person, please, first.
Yes. So I'll follow the outline then that you gave me. Yeah. I'm so eager to get into it, David. I just want to know what's going on in the market, man. Where are we going? Right?
Everyone knows.
I want to hear from these smart people.
I like your style, man. I like your style.
Yeah. So let's do that. Let's go through and introduce our distinguished panel. Have them just introduce themselves, their service, just a quick minute or two about who you are, what you do. And we will start. We'll just walk through the same order the whole show here. We'll start with Jim Kenney of OptionProfessor.com.
Sure. And good to be here as well. OptionProfessor.com is an education firm, and I provided the content to the DVDs. There's 7 DVDs there, and basically it goes through the basics and then advances in each DVD to different strategies as far as writing the options, buying the options, what's the unique risk to each strategy, and how after the markets start moving, how adjusting the strategies can be done. So basically from an education and a little bit more know-how basis, they add a lot of value to the investors out there, and that's their purpose.
All right, great. Thanks, Jim. And next we go to John Netto of the ProteinTrader.com. Oh, I think you're muted.
Hey, John, you're still muted.
Sorry. My name is John Netto. I'm a cross-asset class trader. I'm also author of this book here, The Global Macro Edge, Maximizing Return Punitive Risk. I pay very close attention to the underlying macro narrative, incorporate that into my overall trading strategies. I support myself fully for my trading P&L and have a 6-year audited track record as part of my book to substantiate as such. So everything I do and say, how I pay my bills, all comes purely from my trading P&L.
Outstanding. Thank you, John. And then bringing up the bottom of the order here, Sam Bourgi of TradingGods.net.
Hi, everyone. My name is Sam Bourgi of Trading Gods. Our service is dedicated toward trading volatility as an asset and teaching traders how to access the volatility markets, CBOE VIX, the various ETNs, options, and futures. I do a lot of work there around education. I'm a markets editor there. We do a lot of online coaching, a lot of webinars and daily articles dissecting the volatility markets as they happen. Very happy to be here.
Great. Thanks, Sam. And I'm Dean Jenkins, founder of FollowMeTrades.com. And Follow Me Trades is our core product is a stock and option picking service. And we've got about a 4-year track record up on the website that has been verified as well. And I'm glad to be here. I also offer some educational products, but the central thing is stock and option picking and trend or swing trading. All right, we got a good lineup here. And now, David, can I get to the market? Can we talk about where it's going?
Yes, go ahead.
Okay. All right, so question number 1. What direction do you think the S&P 500 index will move from Monday's open, this morning's open, till Friday's close? That's December 12th through the 16th. And the survey results said 59% higher. And David's statistical method gave that about a 70% average accuracy or probability. So the question to each panelist then was, what do you think? Part A to the question is what direction you think it's going to go, and what's your confidence in that number? And we'll start back at the top with Jim.
Sure. Well, my best guess here is that an analogy might be trying to anticipate cars at the Indy 500 to slow down when you're looking at them going 200 miles an hour, meaning we're kind of in new high territory in so many different indices that to have an opinion of anything but up sounds kind of silly. But my thought is that just like the cars on the Indy 500 when they're going 200 and it looks like they will never slow down, they all have to stop for a pit stop to get some gas. And this week could be a week where they need to gas up again. There's a lot of information coming up later in the week. I guess there's questions on that coming up, so I'm not going to digress into that right now. But I would say that with today's highs in the indexes, like the S&P, it'd be a nice line in the sand to use, and then maybe anticipate a little bit of a pause to refresh pullback. And the transports being rolling over here pretty good today might be an indicator that that could be the way it goes.
All right. So our first up says down. The pause that refreshes.
Yeah.
All right. Let's see how the rest of the panel. Boy, I hope we get a little dissension. Some respectful dialogue. Back and forth. But it's never fun if everybody agrees on the same direction. So, John, are you with Jim, or are you contrarian to that?
Well, I think it's fun if everyone agrees and we're right, because
that's what I was thinking.
Well,
there's that. There is that. Yeah.
So listen, I walk through an exercise before every market week, and I ask myself, okay, if I put on, a pure vertical, a pure 50 delta vertical option spread, meaning let's say the S&P's at 2250 right now. So if I bought the 2230 and sold the 2270, okay, what would I rather be? Would I rather sell the call or buy the call spread in that situation? In terms of where it's going to close. And for me, doing that, I'd rather buy the call spread and benefit from some modest upside delta, having total respect and deference to everything that my predecessor just said with regards to where we are technically and how we may pull back with a line in the sand. But the path of least resistance is still up. I don't know that the risk reward for that is there. And so in terms of from a yes, no situation, I think we close modestly higher, but from a risk reward profile, I'm not sure there's much benefit to being exposed either way. But that being said, path of least resistance is higher. I'd rather be long the call spread than short the call spread with a 50 delta, neutralizing the rest of my Greeks. So that's my call for this, where we are right now.
All right. Well, I forgot to get from Jim the confidence level. What's your confidence level on that direction, John?
Like I say, with the line in the sand up there, my guess on this is that it would be probably a little bit over 50-50. So call it 55.
Okay, 55 down for Jim. John, what's your confidence?
55 as well. And honestly, the difference between Jim and I is very minimal. I think we're both probably thinking the same thing. It's just a question of where are we at 4 p.m. on Friday, not, we're going to tank or we're going to rip,
Okay. Sam, tiebreaker.
Yeah, I see both sides of the equation, and I think I'm in the same boat as the previous two. I do like Jim's analogy there. I think that the market or the S&P will finish slightly lower this week, and I'm really monitoring volatility. Last week we saw a situation where the S&P was breaking all-time highs, but volatility was still creeping up slightly, and that's rare when it comes to the CBOE VIX and how it relates to the S&P 500. So, I think that the post-election boom is still happening, and I think that we're still in that uptrend. But for this week, if I had to give an educated opinion, it would be slightly lower. And my probability for that, I would say, is around, let's say, 51%, because it can go either way.
All right, so we got 2 down, 1 up, and not a ton of confidence. 55, 55, 51. Yeah,
I would harken back to my sports betting days. I live here in Las Vegas, and I did a lot of odds making and a lot of model building around point spreads. And I would say this is like bringing three of us on to ask who we like the point spread winner in the Super Bowl. You know, like the Super Bowl point spread is probably the hardest number to beat in terms of how good and how sharp the number is. And so that's not really where you're looking to take on, you know, where there's like a mispricing or a chance for price discovery. So I think all three of us basically are at the same, we've all just made the same prediction, if I gather that correctly, which makes sense given the metrics.
Yeah, I think that's a good observation. This is it's a tough thing to predict right now. It's always tough to predict it, right? If we can do that well, then we got it going on. If we're, you know, it's really how do you trade it, right? And so, so it's my turn, and I believe it's going down. And I'll share my screen when we get to the number 3 here and talk about why. I'm a technical trader. I use a combination of Elliott Wave and Ichimoku Cloud, and we've got some technical indicators with today's open showing that we may have a bit of a correction coming that could last, you know, through this week. And so I'll give that, because the indicators are getting pretty clear, I'll give that a higher confidence, up into the 65 to 70. So call it 70, pick a number. 70% confidence that we're going to close down by the end of the week. So we got 3 down, 1 up. But again, almost the same answer on the first 3 you said, because of the confidence level. All right. And again, the survey numbers that David puts together gave it a market going up with a 60% chance higher, if I interpret your data correctly, David. So some of you already touched on it a little bit, but this is your chance here in question number 3 to elaborate a little bit more. And at this point, you can share a chart if you like, or just give any, you know, expand on your reason, your rationale for the answer you gave to questions 1 and 2, the direction and the probability. So we'll run back through here. Jim, if you want to expand on your answer a little bit, this is your time.
Well, again, you know, we have a 2270 high on the E-mini S&P, and now it's trading 2254. We have a high of the NASDAQ future at 4917, now trading 4860. And the one that's really been on the bicycle, that Russell, hit a high at 1396 and is trading 1371. So it doesn't look like the appetite for people to start buying the all-time highs right in front of Wednesday and Thursday and Friday's information, particularly Wednesday and Thursday with all the data coming out. The appetite to continue to press this thing to the upside seems to be abating. So that's pretty much the long and short of this thing. You know, on a bigger view, you know, here in Las Vegas, you have a game called craps, and you know, you have a lot of people who bet what they call the come line in anticipation that things will be good. And we have had a certain amount not a certain amount, we've had a large amount of people obviously anticipating that the Trump regime will be positive for business and positive for the small caps and positive. So those bets have been made. And you never always have to never forget somebody's fading this action. And just like in the game of craps, if the shooter is hot and everyone puts their money out there and then he rolls a bad number, there's a big rake that comes in and they take all the chips off the table. And so with these huge advances before the gentleman has even taken office, you have to at least give some concept to the idea that the come line bettors are maybe getting a little ahead of themselves.
You know, I actually agree with that, because everything that's been promised, right, it's a long way off to being realized, if it can be, right? So the rally, I think at some point, you know, folks are going to look around and go, what's changed now, right? So I think there may be a bit of reality checking coming, at least short-term, smaller move. But John, if you'd like to expand on your
yeah, I'll take the other side of that argument just to keep things interesting here, in terms of what the Trump rally has meant, and I think it was more a reflection of who was off sides. And so a lot of what I do in terms of is I build probability analysis around macro narratives or more qualitative fundamental things in terms of what this event can do, what the FOMC can say, what the summary of economic projections, which this is a quarterly Fed meeting coming up. And so really the big key is, does much of the language change? out of the FOMC, and what happens in the summary of economic projections. And so I believe for your scenario to work, for the S&P to be down, we're going to have to see the dot plot move from 2 hikes next year to 3 hikes next year. And every Fed governor and speaker out there, especially the bottom 4, which are the ones that we matter the most, are the 17 dots that are on the 2017 dot plot. It's those bottom 4 which represent Dudley, Yellen, Brainerd, that most of the market respects and really pays attention to. So if the Fed, which has said it repeatedly, kind of following up on your point, that until they see what actual fiscal stimulus goes in, irrespective of what the 5-year break-evens and the 10-year break-evens mean in terms of price and future inflation, and despite what oil is doing right now today, being up another 5% on the day, the Fed is actually going to risk letting the economy run a little bit hot. And so I think if we got some hawkish commentary out of the Fed this week on Wednesday, then yes, that scenario could play out. But the reality is that most people, most money managers, were caught off sides by this Trump win and have not built into their models the price of lower taxes and lower regulation. And so while I agree that technically this thing may pause, the idea that we're talking 8 years of a certain presidential and political regime, the unwinding of that regime is not a 3 or 4 week endeavor. The unwinding of that regime can last months, if not a year or two, as people have to reprice and rebalance their portfolios. So I think there's enough people caught off sides right now that, you know, they may be betting on the come line, but there's a lot more people that didn't have enough bets on the come line, I would say, because we're both using Las Vegas analogies, as we're both here in Las Vegas. It's still not enough. So for me, it's a market position issue. It's an FOMC issue in terms of what they're going to say. I think the dot plot comes out at two dots. And if you wanted to do anything in this regard, maybe get long some duration, long some 30-year, because, you know, there's a sense that first of all, for the first time, we actually have the market in terms of iOS and Fed priced at the same level in 2017. For the most part, we all know how bad the Fed has been in terms of not only forecasting the dot plot, but just forecasting the economy in general. And so for me, the market's kind of become now congruent with where the Fed is. And unless the Fed actually expresses that they're going to have to hike faster than expected, or they remove the word gradual from their statement, I don't see how the S&P sells off or even stays down this week, because there's simply too many people caught off sides that will have to buy the dip tactically, and that's enough to have the market close even slightly positive, even given how overbought we are. That's all I got.
That's all?
Yeah. That's the global macro edge.
All right, man. Thank you, Sam. I'm sorry, John. Now we go to Sam. Sam, do you want to expand on your
Well, yeah, I mean, just an observation about the Trump rally that I found interesting. I mean, I documented this thing so much leading up to the election. I mean, there seemed to be a consensus that Wall Street was in favor of Clinton, and that, you know, Trump was considered the so-called wild card candidate, and that his election was going to lead to a huge sell-off in the market. It really is amazing how quickly sentiment can change, right? Because we saw that initial plunge in the futures market after he was elected, but since then it's been booming. So I think that it really is interesting how quickly that outlook can change. Now, in terms of this week and what I'm looking at, I mentioned earlier the volatility aspect of it. The VIX last week moved in lockstep with the S&P on a few occasions, which is rare. So I'm seeing that movement, and that could be a trigger for a slight decline this week. But like I said earlier, I mean, I'm pretty much on the fence with this one. I can really see it going both ways. It's interesting with regards to the Fed. I just saw a forecast by the Wall Street Journal, or they had did a survey with a few economists, and they were actually expecting something like 3 or 4 rate hikes next year. So it'll be interesting to see how fast that happens. Obviously, expectations around inflation are going to be key. So again, I can see both sides of the argument this week. It's going to be an interesting one, but I'm going to keep my eye out on the volatility index.
All right. Thanks, Sam. And again, our prediction is for a week, right? Not for the year. A couple folks have talked about the post-election results. That's really interesting. I just read an article this weekend from Business Insider that said they had gone and surveyed the top analysts at the top Wall Street firms, like 10 firms, and they said no analyst at a top Wall Street firm is predicting the end of the bull market in 2017. I just thought that was a stunning statement, that you get that kind of consensus, and you know, I would call it crowd mentality, because just only a few weeks ago, that same group of folks were predicting a market crash if Trump got elected, right? And so that's a fairly emotional reaction because no data has really changed. And so, and even like Mark Cuban, right? He was so vocal. Boy, if Trump gets elected, the world's going to end and the market's going to crash. And all of a sudden, a few weeks later, I was like, well, yeah, it might be okay. Those are emotional decisions. Those are not technical or fundamental decisions. I just think that's really interesting, and it's got my attention to watch. And like I say, I'm a technical trader, and so I listen to all that stuff, and it's good it's good information, good entertainment. But I'm looking at the charts to make my trading decisions. I'm gonna go ahead and share my chart now. So this is the E-mini. I hope you guys can see this. Hope it's sharing. This is the S&P 500 E-mini futures on a 30-minute contract. And if we just look, this is the latest impulsive move starting back on December 4th. And that impulsive move lasted up through Friday, and then through the weekend's open, and through the weekend, the weekend session yesterday and today, you can see we've broken down. We're starting to lose momentum. We're down through the Ichimoku cloud. I think that indicator has some value and meaning. And on our momentum oscillator, we're starting to lose some momentum. And I've got a Fibonacci retracement zone defined here down between about 2230 to 2210. And if we just examine this, right, the Dow theory tells us uptrends are higher highs, higher lows, higher highs, higher lows, lower lows, lower highs, lower lows, lower highs. We got that pattern started. So we already got three things lining up telling us that we probably got just a natural, normal retracement or correction. So even if this trend is going to continue, trends don't go straight up. They have impulsive moves, they have corrective moves, they have impulsive moves. So by the end of this week, just from a technical analysis on this 30-minute time frame, I'm seeing pretty good evidence that we're experiencing a bit of a pullback, and that will continue for a handful of days out to the end of the week. So that's my rationale for thinking that we're going to be going lower by the end of this week. All right. So we've been through the predictions, the confidence, and the rationale for it. Now we go into the special new question, and a few folks have touched on it already. So there's a two-part question, and part A is the FOMC is going to announce their next move this coming Wednesday on the 14th. And so do you think they'll raise their rates? And part B, what impact do you think that decision is going to have? And Jim, if you'd lead us off with your thoughts on the Fed.
Well, my thoughts on the Fed is Lord knows what they'll do, because it's very difficult to figure out what they're looking at. But I would say that since the 10-year yield is up about 50% since the election, and since the 30-year yield's up about 30% since the election, this is one of the most, shall we say, signaled hike in the history of hikes. So I would say that they're going to hike their rate a bit, and then maybe the statement will quell some of the excitement in the bond market. So people who own bonds that have taken big hits since the election, they may get a little respite here because maybe the Fed will not be as robust on things like the economy or earnings or other things like that. And they'll throw a little cold water on the massive decline in the bond market that we've seen in the last month. And maybe, the statement will be more, sanguine.
Sanguine. There's the word of the day. Love it. Okay, John, if you'd like to.
That's a great word.
Yeah. Yeah.
That's how you get a 750 on your verbal SATs, is to know and use sanguine.
And he used it incorrectly in a sentence, so there's bonus points
That's
there.
bonus points for that as well.
Yeah. So what do you think, John? What's the Fed going to do? What impact is it going to have?
Sure. Let me follow up just a little bit on my FOMC assessment from earlier. And the FOMC, obviously they spend a lot of time. They have more economists at the Fed than any other institution in the world. they understand that when it comes to tax cuts and what Trump's proposing, that really they're not potentially even looking to take effect until sometime in 2018. So unless what takes place is when George Bush was president, whatever, 12 years ago, 16 years ago, when the tax cuts were made retroactive to that same calendar year, I mean, clearly business will change if regulation, is reduced and tax structures are put into place. But in terms of a lot of the fiscal stimulus that we're talking about, that may not take place until 2018. So I think the Fed reemphasizes that stance that while they maybe, while they're monitoring fiscal stimulus, until they see the data, until they see what actually comes out of it, that's going to be there. So if you get more or less the status quo taking place, you have to go back to how is the S&P operating in an environment with conducive monetary policy, which is what we've had for the last 8 years, or incredibly accommodative monetary policy, and now the potential, at least with the trend being towards greater fiscal stimulus and less regulation. And if that's the case, you get an S&P that basically grinds to new highs. It's like that Geico commercial, when you they always have these examples of someone doing something. It's like, if you want to save do this. If you want to save 50% of car insurance, call Geico. Well, if you want to watch the S&P in a bull market, the S&P grinds to new highs. That's what the S&P does in this market regime. And given what I see coming out of Wednesday, given the delay time it takes for this fiscal stimulus to take place, and unless there's a game changer in terms of when they're able to enact a lot of these tax cuts, I don't see the Fed changing their language or changing what they project in their inflation or their Fed funds forecasts.
Okay, so no change.
No change.
So they will do the rate increase in December as signaled.
Yeah, right. And here's the big thing about that. Let me just close on this. Is that so? I'm just giving you this superficial analysis about what the macro narrative is and what's going to happen. Now, this is why I call myself the protean trader, because protean means highly versatile, easily adaptable, and able to take on many shapes and forms. So the Fed drops a little language bomb in their statement, Dean, then I'm going to revert to your chart, okay, and have that macro narrative and that macro context to immediately go short. And that, in a nutshell, is what I do. Is I have a really deep, rich understanding of the macro narrative. You overlay that on a number of technical trading systems, apply the context, and then trade. So if they come out and all of a sudden hint, well, the Fed is going to be a little more attentive towards inflation because we think the fiscal policy could be stimulative, which would be a surprise, short the heck out of the S&P. Buy S&P puts because they haven't priced those puts high enough yet to account for a more hawkish Fed. A more hawkish Fed is not priced into the volatility market right now. And going on following the volatility index, that's a place maybe you want to get some exposure if that language, changes accordingly, because then you're looking at a beeline for the next 2 weeks till the year ends for you to be short the market and to sell risk while they reprice a more hawkish Fed.
I wish you had an opinion.
It's tough. It's tough being me. I'm telling you.
Oh, I just appreciate your passion, man. It's obvious you spend a lot of time thinking about this, and you're just into it, man. I enjoy it.
A little bit less with a 5-week-old baby now, but still a lot of time.
Congratulations on the baby.
Thank you, sir.
Okay, Sam, make your case.
Well,
what's the Fed going to do, and how does it matter?
Well, I've been eyeing this December meeting all the way back since the spring. I didn't think that they would do anything before the election. The narrative since then has, definitely increased in favor of raising rates. I do think we'll see a quarter-point raise on Wednesday. Obviously, the Fed funds futures markets imply that as well. I don't necessarily think that the language is going to change simply because, Trump isn't even in office yet for us to talk about inflation. I know that Yellen did talk to the Senate Banking Committee last month, and she mentioned some things about inflation maybe going faster. I think that language may eventually work its way in. I don't necessarily see that happening now. In terms of the impact, I look at the broader market on this. You see the U.S. dollar is already at nearly 14-year highs. Gold has plunged something like $140 since early November. I think that a rate hike has already been priced into the market. So I don't necessarily think that's going to have a major impact on the direction of current asset classes. So that's really what I'm looking at. I do definitely, let's put it this way, I will be shocked if they don't raise rates on Wednesday. I think that it's definitely leading in that direction. I don't think the impact will be as acute as it normally would be, given the anticipation and given the fact that it's already been priced into a lot of markets.
All right, thanks, Sam. I read the answers to this question in David's survey and the respondents, and overwhelmingly, the respondents that did the survey said, yeah, it's going to happen, and it's already priced in, so really no impact. So I believe that as well. I think it's going to happen. I think it was Jim said, the most signaled rate hike in history. That's a great comment. So, barring any really new information, I think it will be.
Last year, the rate hike in December of 2015 was as signaled. It was a same pricing as well, 94%, 95%.
Yeah, it could be fair.
It was the first rate hike in like 9 years, and it was also totally telegraphed and absolutely priced into the market as well.
So there's typically some momentary volatility around, and I have a trading room. We'll be day trading.
But I think that I mentioned earlier the relationship between the VIX and the S&P 500. Last week we saw both the S&P and the VIX rise on back-to-back occasions. That's only happened, I believe, something like 90 times between 1990 and 2016. So it's a very, very rare occurrence for the VIX and the S&P to move in the same direction on back-to-back occasions. So I think that there may be a play in the volatility market this week, especially around the Fed release. So there may be an opportunity to long the VXX, for example, that ETN, because it's really good for those short-term spikes in volatility. Obviously, as it was alluded to earlier, volatility is still very low by historical standards, but there may be a good short-term play, and using a tool like the VXX might be beneficial this week.
Okay. Long the VIX.
Yes, the VXX, I would say, yeah.
VXX, right? Yeah, I've played that before with the UVXY. I kind of like that too. That's a fun instrument. So I'm gonna go ahead and share my screen. If I can figure out how to do that. And so I like oil. A couple things going on here on oil. I think last week OPEC made an agreement, that they're going to cut production and try and raise prices. OPEC is notoriously fickle. I love the quote from the previous Saudi energy minister who said, "Yeah, the production cut could work, but the problem is we cheat." Right? And so, will OPEC actually, individual members actually do what they said in terms of a production cut to lower supply, raise demand, raise the price? Remains to be seen, but kind of a new thing with other oil producing countries, most noteworthy Russia, saying they're going to join OPEC in production cuts in order to drive prices up. That's a pretty rare thing. And you can see that oil's up over 5%, pre-market's up 3.25% right now on that news primarily. Now, is that, are those unlikely bedfellows really going to stay in bed? Is that really going to happen? That remains to be seen. That's a big if, and there'll probably be some real volatility. But from a technical standpoint, we got moved down in oil from over $120 down into the 35 on oil futures, and we do see technical signs of it coming up off the bottom. It's ragged, it's volatile, but we've just taken out a couple significant previous highs, and it looks like the next leg of this recovery could be getting going. And the retracement zone from that big move down, just a retracement from that, takes us up mid 60s to low 80s. I don't have my fib lines on here. This really does get underway if these guys really do play nice with each other. Cut back production, we could see a pretty significant move in oil, and we're already trading that. So you can just trade that with USO, and you can write out the volatility just going along the calls on USO. They're pretty reasonably priced, pretty deep market there, and you can get them far out in time and just wait that out. Or you can go look at individual issues. One right now that I really like, it's doing well. ESV. So we got into this thing at $9.10. It's up over 11. We've already taken a little profit, but a price target on ESV way up here at 1937. So still time to get in and participate in this energy related. There's two, right? I like USO. I like oil. It's gonna be a ride. So you got to have fairly big stops. You know, control your position, control your loss that way, and maybe just take a longer view with some calls out, you know, deep into next year. So that's what I like right now. Energy. Sharing. Come back to the screen here. Good stuff. Just the final part, the final question here to cover, and that's for each of the. Just give any closing thoughts you have on the market, trading, and any final statements you'd like to make about your service, yourself, something you'd like the attendees to hear from you. So, and Jim, why don't you wrap it up?
Sure. Sure. You know, just looking at the universe of different things, you know, sectors that I keep an eye on, you know, again, just an opinions here. You know, the stock market obviously very, very strong, and it has year-end volatility that can happen due to tax selling and tax activity. And then there's a January effect to respect, which is some seasonality that can give a tailwind to it. But by the time this new president takes his inauguration, you know, a lot of that will be behind us. And it'll be very interesting to see exactly what materializes, you know, after that period of time. So, you know, obviously the moving averages are all positive on stock, and the momentum has been positive on stock. So, like my analogy to the Indy 500, you know, it seems actually silly and ridiculous to think of it going the other way. But again, just like 200-mile-an-hour cars, at some point they do have to take a pit stop. Looking towards and of course the Q4 earnings and all that nonsense called facts, you know, they could come into the market and be a little bit, it has to, you know, obviously start giving out some confirmations. You know, the big thing here is this bond market. You know, a lot of bonds have been called in the last few years, and they've been reissued at 3%, 2%, 1% negative interest. And so the Fed's in a little bit of a pickle here, I think, because, you know, while some of the numbers might say be more aggressive on the hiking, you know, they have to be very respectful that the world is awash in debt. And, you know, retirees who start seeing their bond portfolios dropping off, you know, may have not that much patience. And if you get into an order imbalance, which we've seen in our careers in 2008 and 2000, 1987, and many other times, the order imbalance could happen in the debt market if these rates, you know, matriculate, you know, significantly higher. And that's something to keep a good close eye on, because again, particularly in the municipal bond market, you know, a lot of money in there. And if this guy's going to cut tax rates, you know, people may say, hey, I'm losing money on these tax-free bonds, but we also don't need them because of what? He's cutting the income tax rates. So there could be some volatility in the bond market that could be substantial, and I'm sure the Fed's well aware of that. Oil, like you guys were mentioning, you know, OPEC and non-OPEC agreed to cuts. The guys who I've listened to and read up on, and the information I get, was saying a 60-40 trading range forward-looking on oil. And as I look at the charts, you know, if we broke above 60 with some kind of special circumstance, going up towards 80 is not off the table either. But the momentum on oil certainly has turned up, and that 60-40 trading range is looking pretty reasonable right now. These metals seem to be very much near their lower areas, but if they were to break to new lows, Lord knows where they would be going. So this 14 area on silver and 1,000, 1,100, whatever on the gold, be very interesting to see if they can hold up down there. So, you know, a lot of things coming into play here. And it'll be, you know, obviously very exciting to see how things break. So with Option Professor, at least you could understand the different strategies that are available that could be applied based on your suitability and your circumstances. And the 7 DVDs certainly are balanced, and they're educational, and they definitely, I think, add value to the investor's arsenal of information. So, you know, check out the Option Professor DVDs if you could.
thank you. Thanks for being here and for your contribution to the good discussion here. John, if you want to wrap up, closing thoughts and anything you'd like folks to know about.
Yeah, stay fluid, stay flexible. My book, this brick here, The Global Macro Edge, took me 5.5 years to write, close to 3,000 hours. I wanted to memorialize my thoughts, my process that I've done. You go to my webpage and see my 6-year verified track record by a CPA that I hired, where I took $100,000 of a risk budget and generated $3.1 million in trading profits, all verified by CPA, all actual trades. I say buy this book. It's my heart and soul. If you want an easy path to trading profits, this is not the answer. Don't buy it. Don't waste your time. But if you're ready to work a year or two and really learn how to incorporate the macro narrative, spend $150 on my book or give it to someone you love as a Christmas gift. Thank you for the opportunity to share my thoughts today. I appreciate it, sir.
Yeah, thank you for being here. And I'm disappointed. I thought there was an easy path to trading riches.
Years and a lot of pain, a lot of sweat, a lot of adversity, but it can be done. That's what matters.
All right. Wrap up. Any final thoughts, sir?
Sure. I enjoyed the discussion on oil. If I'm going to play devil's advocate a little bit, I mean, there's a sense that higher oil prices, if it does go above $60 a barrel, will just serve as more incentive to attract U.S. shale back into the picture. So I am definitely looking at U.S. shale production. We're seeing active oil rigs rise pretty much every week for the past 4 months. So that's an interesting dynamic. In terms of Russia and Saudi Arabia cooperating, I know that a lot of Russian companies, or based on the reports that I'm reading, aren't in favor of cutting production. So given the fact that most of Russia's oil industry isn't state-run, I just wonder how the Kremlin's going to go about compensating these companies for lost output. And finally, Saudi Arabia just raised its output in November to a new record amid the production talks. So we are going to see, based on what we know, a 1.8 million barrel decline from OPEC and non-OPEC. It's going to be difficult to police, so I'm going to be monitoring that closely into the new year. In terms of trading gods, we currently have a VIX Trader program. It's designed to help traders access volatility as an asset, trade volatility as an asset. It's one of the only programs in existence that really delve deep into how to trade volatility, the various ETNs, options, and futures on volatility. So we currently have a $9 trading program for the VIX. You can try the VIX Trader for 2 weeks, risk-free, for $9. Give us a shot, and we look forward to seeing you on the other side.
All right, thanks, Sam. Yeah, and I appreciate your comments on oil there. It certainly is not a given, right? And it's a volatile, but I think there is a chance that it could be heading back up. You know, between 60 and 80. I think Jim affirmed that as well. And you know, if that happens, you know, it's going to be bad news at the gas pump. But if you get that trade right, you can go buy a Tesla and it won't matter to you, right?
That's a good one.
All right. So just for me to wrap up, you know, the thing, whenever I get a chance to talk to traders, I just love to emphasize risk control. It's the cornerstone to everything. You got to know, you know, the first question in a trade is not how much am I going to make, but it's how much could I lose, and to control that to an acceptable level and be willing to take that loss. If you're not willing to take that loss, don't take the trade. So risk management, learn it, use it, live it. And follow me trades. You can go to our website. You can sign up for a free newsletter. Every week I publish an article called Beyond the Noise, where we look at what's going on in the market and make specific predictions. And there's a link to our stock picking service and the live trading room as well. I'd love to have you come check it out. It was really fun being here. Great discussion. I enjoyed listening to each of the participants. And I think so David, I'm going to hand it back over to you for final closing comments.
Yeah, thanks everyone. Great show. For those of you watching live, we did have a slight glitch for a couple minutes in the live stream, but as far as I know, everything was recorded. So if you missed any part of the show, just go to TimingResearch.com in a few minutes, and I'll have the recording up there. As long as there's no problem with that once I shut down the broadcast here. Also, be sure to hit the subscribe button on for YouTube, so you can get updates on future shows. Also, you can go to Timing Research and download any of the past reports or watch any of the past shows there. And be sure to join us next week. Barry Burns, Glenn Thompson, Lance Ippolito, and Dave Landry will be back. And so I just want to thank all my guests for this week again. Jim Kenney of OptionProfessor.com, John Netto of TheProteanTrader.com, Sam Bourgi of TradingGods.net, and Dean Jenkins of FollowMeTrades.com. So thanks, everyone.
Thanks, Dave.